What is up? I'm recording this for you. What do I... Hold on. Share. There we go. We're going to share my screen. Um, Content only. Yep. Okay. So, no, wait, I need my thing. Actually, no. Hold on. We're going to go back. Oh my God, get out of here. Okay. What is up, Bella? We are getting out of Excel. What was I doing? Oh, I was going to use the Zoom thing. Hold on. Okay, how does she do this? It's gonna be a very long video of just me figuring out what I'm doing. Whiteboard. No? New whiteboard. Here we go. Okay. Yeah, blah, blah, blah. Get out of here. Here we go. Okay. So you have your current assets. Oh, this sucks. Actually, hold on. We're gonna do our T accounts in this. So we're gonna write all. I actually hate this so bad. We're not gonna do Zoom whiteboard, okay? We're gonna do OneNote. Uh, Add page. There we go. So, am I still sharing my screen? No? Share screen. Yep. Okay. Here we go. Here we go. We're doing it. Oh, I can't see my freaking. Can I move that? I can. Perfect. Okay. Get out of your camera. Ugh. Ew. Okay. So we have cash. I'm just doing all the starting balances, you know? You have accounts receivable for 3,000. You have your supplies for 800. And then you get over here to your non-current assets. Your land is 95,000. I think that changes actually. Your N is 33 or 330,000, whatever. And then right beside or right under that, actually, I lied. We're going to do the depreciation of the N. And that is at 25,900. Right? Yep. And then we're gonna do the furniture for 29,100. And then that accumulated depreciation for the furniture. Oh, that's horrible. Okay. And that number down here is 13,580. Okay, that's all the assets, all your asset accounts. Okay. And then we're going to come over here to our liabilities. We're going to do accounts payable. $12,400. Unearned guest revenue. Na, 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 na. And that starting balance is 6,500. You have salaries payable. And that is a 1,000. And then you have your non-current liabilities. We're just gonna do notes payable, which is 220,000. Oh, 220,000. And then interest payable, which is sitting at 8,800. And that's all the liabilities for there, you know? And then we get over here to our Shroot capital. Uh, and that is 1,000 or 100,000. No, capital goes on this other side. Just kidding. 220. Okay. Okay. Excuse me. Anyway, those are all your starting balances. Okay. So then, hold on, do a little switcheroo here. So then we're gonna go down here to Excel. Oh no, whole thing zoomed in. Yeah, we're gonna go down here to Excel and we are gonna start this freaking journal. Shroot journal. Okay, you got your date out here. You got your date. And then your accounts. Just widen that bad boy out a little more. And then you have your debits and your credits. Okay. Debits, credits. You got your account titles. Okay. So starting out, purchased a 1-year insurance policy. So on September 1st, you're going to have the two accounts affected are prepaid insurance. So you'll type prepaid insurance. And then it's 1,800. And your credit is 1,800 for cash. Bro, don't even run out. Old age. 6. Okay. Alt H6. Why are you beeping at me? I don't care. One more. Okay, I don't like this date set up, so we're going to change that number. More number formats. Date. We're just gonna do this one. Right? And then we move on to September 3rd. And over here, it says paid the amount for $5,000 of the amount owed on account. So your two accounts that are affected are accounts payable, and it's a debit because you're decreasing it, and it's a liability. So that's 5,000. And you paid it, so it's cash. I guess it's just gonna beep at me every time I indent. Whatever. On September 5th, you paid salaries of 2,000. So you're gonna do down here, you're gonna indent. Get out of here. You're gonna indent, type cash, and then that was 2,000, right? And your others are equally divided because half of that amount related to August salaries that had been accrued at 8/31. So you're going to do salaries payable, and you're decreasing it. And then the other half of the salaries was earned in the first week of September. So it's salaries expense. Why are you indenting? And then we move on to the 7th. Earned $8,000 of guest revenue. Okay. 6,500 of which was related to guest stays, which had been paid for in advance in August. So your accounts that are affected are unearned guest revenue. And then you have the and then the other 1,500 was collected upon guest checkout today. So you have cash, and then you indent one more time that I do it. And then you have guest revenue. Okay? So you got 6,500 was previously paid, and you have 1,500, which was paid in cash upon checkout today, right there. And the total of that is 8,000. So you're going to do 8,000 in guest revenue. Over here, September 11th. It says the owner, Dwight Schrute, withdrew $2,000 from the company for personal use to purchase new clothing that would be appropriate for the assistant regional manager. So your two accounts affected are draws, which is a debit because you're increasing it, and then you're crediting cash. So he took $2,000 out of the company. So you're taking $2,000 out of cash. And then September 18th is the next one. All right, purchased additional supplies on account for the amount of 1,300. So you're gonna debit supplies because you're increasing it for 1,300, not 14, 1,300, not 13,000, 1,300, 1,300 on account. So you do your little indent for accounts payable. And then you go on to the next one. September 19th. Paid salaries expense of $2,000 for the period 9/8 through 9/19. So it's in September. So you paid salaries expense and you paid it. So it's in cash. So you do your little indent. And how much was it? $2,000. So you have $2,000 for your expenses and cash. September 20th over here. Collected 1,800 for the amount owed to us on account. So you debit cash because you're receiving cash. You're receiving 1,800. And do your little indent. What in the world? One day I'll get it. And then you're decreasing accounts payable or accounts receivable. Right? So you do that for 1,800. And then September 22nd, over here, we collected 18 or 10,800 from guests. 1,800 of that amount was advanced payments for October guests. So you immediately have unearned revenue, which will be a debit. So that's 1,800. And I'll move that down in a second. And the rest was revenue collected from guests upon checkout. So the rest of that is 9,000. So you have your revenue and then hold on. Move that down. You have cash. You have unearned guest revenue, which is a liability. And so you credit it. And then 9,000. And you got 10,800 from guests. Moving on to 9/24. Incurred catering expense for the month of 1,500 on account. So expenses are debits. So you do catering expense. Don't indent. Okay. Where was I? Catering expense. For 1,500. And then it just says incurred. So you didn't pay it. So it's on account. So you do your little indent. Account payable for 1,500. And then September 30th. Incurred and paid utilities for the month totaling 2,100. So you have utilities expense for 2,100. And it says right here that you paid it. So you paid it. So you used cash. Cash. All right. Okay, these are your simple entries, like that's it. So here's all of this. So I'm going to move this over here and we're going to go back to get out of here. Where's my pen? All right, we're going to go back and we're going to go through and journalize these things, okay? Okay, hold on. Let's make the accounts first. Okay, hold on. How do I get out of there? Okay. So you have prepaid insurance. And maybe straighten that up. You have prepaid insurance for 1,800. It's an asset. And then you you did cash. You credited cash, so 1,800. And then you have 5,000 to accounts payable. And you're decreasing accounts payable, so you're debiting it. And then you're decreasing cash as well. So you're crediting it. Your salaries payable down here is decreasing. And your salaries expense, oh, we didn't get to expenses. Hold on. Let me do the revenue first, actually. You got your guest revenue. You got your and then you go on to do your expense. Well, hold on. Let's go over here first and do our draws. I know I'm kind of jumping around. I'm sorry. But yeah, let's go ahead and list these expenses. So what expenses do we have over here? We have the salaries expense. Don't know why that's an arrow. Whatever. So we have salaries expense down here. And then we have the catering expense. And then we have the utilities expense. All right. Okay. I think that's basically it until we get to the adjusting entries. Actually, you know what? We're going to go ahead and do that. Well, okay, we can go ahead and write these in. Where did I stop? Salaries expense is 1,000. And then salaries payable, did I already do that one? Yep. And you're also decreasing cash by 2,000. All right. Wait, okay. Let me just double check myself. View, new window, file. Yeah, okay. We're chilling. So you got your 2,000 in cash. And then you go down to your guest revenue and make that 8,000. Right? Yep. Or wait. Did I do that right? Yeah, I think. Whatever. La 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 la. I think I did that right. Yeah, definitely. Guest revenue. And you do your unearned guest revenue. That's decreasing because that money was paid. Yeah, there we go. And then we go over here to our draws. Our drawers. And he took 2,000 out of the business. And they take 2,000 out of cash. Wait, I'm skipping something. You got 1,500 from this one, 997. Okay, and then you move on to supplies on 918. So you bought supplies, so you got 1,300. And then that was on account. So you go down here to accounts payable. You can do 1,300. And then salaries expense increased again by 2,000. And that was paid. So another $2,000 out of cash. But then you put 1,800 in cash from getting money, and you decrease accounts receivable by 1,800. And then moving on, down here on the 22nd, we got 10,800 in cash. So 10,800 in cash. And that's unearned guest revenue, so you got 1,800 down here. And then the rest of that was regular revenue, so that's 9,000 down here in guest revenue. And then you incurred your catering expense for 1,500. And that was paid on account, so you do accounts payable for 1,500. And then our last regular thing is our utilities expense, and we paid that out. Let's go up here to cash and take that 2,100 out. Let's go down here to our utilities expense. Go ahead and do that 2,100. So I'm going to circle all these in blue. Well, all the easy ones. Okay, 3,000 minus 1,800. That is 1,200 in accounts receivable. That's 800. That's, nope, 2,100. Land, you don't need to change anything with that. None of this we have to change. You get our prepaid insurance. I can't remember these totals off the top of my head. So I'm going to cheat a little bit and use my thing. But who cares? Who cares? Okay, also, all this math, allegedly, is 19,700. And then you got, what other math was there? That's not this one. Okay, you got your accounts payable. All of this. Where's it at? Am I tweaking? I definitely am tweaking. There we go. This allegedly is 10,200. Our unearned guest revenue is 1,800. Our salaries payable evens out at 0. And then our notes payable doesn't change. Our interest payable doesn't change just yet. Wherever that is. Yeah, so it's our 18 or 8,800. This is going to be a very long video, and I'm really sorry about that. But, at least you have a video. Okay, and then nothing else changes to that. And then you got our guest revenue down here. 8,000 plus 9,000 is 17,000. And then you got our salaries expense, which is 3,000. And then you got our catering and utilities. And that's about it. Okay. So with all those totals in this very convoluted video, bro, my pen won't go back in there. I'm trying to flip it. Okay. Here we go. So with all of these little totals, you don't have to do whatever. Okay. Excuse me. I'm just going to move over here. I really don't care. So Alt HMC. You got Shroot. Shroot, whatever it is. What's the business name? Shroot Farms. So you got Shroot Farms up here. Hello? And then Alt HMC. And then it is the trial balance. Non-adjusted. Can I spell? Man. Is there any way that I can like, you know what I mean? I'm not even saying anything. Okay, and your trial balance is just dated, whatever. So you do September 31, right? 31, 30, 2027, I think, what it was, right? 2025, just kidding. Psych, I lied. Did I even do that right? I can't remember. How do I broken this freaking bro? Oh, for the month ended. Okay, my bad. For the month ended. Okay. And she said classified trial balance. Did I even do that? Wait, no, it's classified balance sheet that she likes, not the. What am I even yapping about at this point? Oh my God. Anyway, we're gonna go through and we're gonna list all our accounts. Okay. This is our debits. This is our credits. Okay. Accounts. So we got cash, accounts, receivable, and then the rest don't matter. So supplies, land, in accumulated depreciation of the in, and then you got furniture, accumulated depreciation, the furniture. You got your prepaid insurance. I'm just shortening these. I don't care. I really don't care. Okay, and then you get into your liabilities. So you got accounts payable and then unearned guest revenue. Then you got salaries payable, notes payable, interest payable. Okay, that's all the payables. And then you got your capital account. So you got Shroot. No, not Shroot Farms, stupid. Yeah, Shroot Capital. And then you got your draws. And then you got guest revenue. If I can type revenue. And then you get in, that's your only revenue account. So you got salaries, expense. You got catering expense. I'm not typing out expense. And then utilities, expense. This freaking thing's in the way. Get out of here. Mess that up. Okay. So we're going to highlight these and merge these across. And then over here, we're going to zoom in and we're going to get these totals. So you got 19,700, accounts receivables 1,200. You got your supplies for 2,100, land for 95,000. You got your in for 33 or 333,000. Your accumulated depreciation is a credit, so you get 25,900. Your furniture is 25 29,100. Then your depreciation's 15 or 13,580. Not dyslexic, I promise. Your prepaid insurance is 1,800. Scroll back over here. You got your accounts payables 10,200. Oh, wrong scrolling. Your unearned guest revenues 1,800. Salaries payable is 0. Don't even know why I put this on the stupid list. Dummy, cancel. Move all this stuff up. Yeah, blah, blah, blah. Remerge. Alt H. Okay, you got your notes payable, which is 220,000. Your interest payable is 8,800. Your capital is something, 193,220. Your draws over here is 2,000. And then you got your revenue, which is 17,000. You got your salaries expense, which is 3,000. Catering expense, which is 1,500. And your utilities. Okay. And then down here, we're going to have totals. Okay. So how you do this is you do sum or equals sum and then the parentheses. And then it'll just do the math for you. Close that parentheses. And then equals sum. Do that math. Close that parentheses. And guess what? We balance. Okay. And then, okay. So select your numbers up here. And then to go to number. And then I do accounting. And then I take away those decimal points. Take them away, not add them. Well, add a couple so we get some space in here. Okay. And then you can do a little double border thing up in here. Yeah, you can do bottom double border right there. That's how you do that. Okay. So that's your trial balance. But then we got to come over here. We are going to do the adjusting entries. Where? Over here. There we go. We're going to scroll down. Okay, that's too small. Can't read that. Okay. I'm going to put the adjusting entries in red. Okay. Okay, not that many. Damn. Font red. Okay. So we got 930 from here on our adjusting entries. Shroot Farms adjusts its books monthly. Prepare adjusting entries as needed on September 30th for the following transactions. At September 30th, the staff of the inn had earned salaries of 1,400, which have not been recorded or paid. So when you get like a salaries expense, you'll debit salaries expense because they've done the work. And then you'll do your little you'll do salaries payable and do your little indent. And it was 1,400. And then that's it for that one. So you'll do your next one, which is a quick count of supplies showed that 1,230 or 1,230 of supplies remained on hand at September 30th. So your supplies, when you have that, it's supplies expense because you used them up. And then you'll debit supply or you'll credit supplies because you used them. And then do your little indent. So you have 1,230 left. So Come over here. How much was left in our supplies? Or 2,100. Let me do that math real quick on this calculator. So you had 2,100 minus 1,230. So you used 870 of your supplies. Get out of here. So your supplies expense is $870 and your supplies credit is 870. Yeah, I'm sorry this is going to be really long because I'm like stupid. The insurance policy taken out on September 1st was a 12-month policy. So that up here, the prepaid insurance is 1,800, right? So divide that into 12. Okay, no, we're not even doing math yet. You have your insurance expense because you used the insurance, and then you credit prepaid insurance because you used it up and you're decreasing it. Okay, back to the math. So 1,800, you got 1,800 divided by 12, which is something. 150. So you use 1 month. So you'll use that 150. You put that 150 up in here, up in here, up in here. Continuing over here, you have the inn has a useful life of 30 years and the furniture has a useful life of 5 years. So how I did that, we're going to go back to notes. Going back to OneNote. So, well, I don't know how much. Okay, the inn has a useful life of 5 years. So you got your 33,000. 5 years is 60 months. So you have your 60. Hold on. Let me get the calculator up here on the screen so you can actually see it. Calculator. So you have, okay, let me see it. So you have this number divided by 60 months because it's 5 years. It's 5,550. Okay. So that's 5,550. Is that, wait, what? Hold on, I'm confused. What did I even do? I might have done that wrong, actually. I think I definitely did that wrong. No, 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 no. What is that number? 25,900. Whoa. That doesn't even make sense. I'm confused. 5 years. That's girl, how did I even get that other number? Has a useful life of 5 years. Let me pause while I figure out what I did. I know what I did now. It's definitely not 5 years. That was the furniture. If I can read the freaking problem. Okay, we're going back. Oh my God. Why did I do that? 30 years. The N is 30 years. Okay. So that's, even then, that's a lot of money. Am I figuring out that I did this wrong? Ah, wait. 0. 30 goes into 30 once. And 0. But even still, that doesn't make sense. Wait. Wait. 11. Oh, bro. 30 years times 12. 360. You know what? Bro, I'm tweaking. Divided by 360. No. 300. Yeah, I'm tripping right now. It's 925. There we go. 30 years. Okay, whatever. Then has, whoa, wrong one. Then has a useful life of 30 years. Okay. Oh my God. It took me so long. Hold on while I attempt to put the stuff back. Okay. So your accumulated depreciation, no, okay. You have depreciation expense. If I can spell it right, oh my God. And then you have accumulated depreciation for your in and your furniture. Okay. So your depreciation expense or your accumulated depreciation is 925. Okay. And then your furniture is worth 29,100. So let me pull up this freaking calculator again. So you have 29,100 divided by 60 because it's 12 months in a year for 5 years is 485. That's where I got these numbers. Haha. 485. Okay. And if you highlight those, you can see the sum in the bottom. So you have your total accumulated depreciation is 1410. Jesus Christ, that took me forever. Anyway, continuing for our, oh my God. The note payable has an annual interest rate of 6%. Both the note and the interest will be repaid in 2027. So that's 2 years away. Capiche? We're gonna go back to one note. Actually, no. What accounts are affected? We have our interest expense because we're accumulating interest expense. Indent these. And then you have interest payable because it's a liability because you have to pay it back. Okay, so we're gonna figure this out in OneNote. Let me flip back around. Yeah, if you don't shut up with your loud breathing. Oh my God. Okay, we have our note payable. Where's it at? So our note is 220,000. So how you get to your interest is your principal times your rate times your time. Okay. Your rate is 0.6%, and your time that has elapsed is 1 month. So you do 1 over 12. So basically, to rewrite this, you can do 220 that thousand, 220,000 times 6% over 12. So that's what we're going to do in our calculator up here. So pull this bad boy back up. Calculator. So you have our note payable times 6%. Okay, never mind. Just kidding. 200. Oh my Lord. I'm having a stroke right now. Times 0.06. Okay. And then, oh my Lord. Hello.
Hello, Dale, do you need outside?
Divided by 12.
Come on.
He's just sitting there staring at it now.
Sit down.
So your total interest is 1,100. So back over here to Excel. Okay. So your interest expense is 1,100. And this is also 1,100. Your interest payable is 1,100. I gotta adjust this really quick to make me mad. Oh my God. I'm having a stroke. Number, accounting, get rid of the decimals because we don't have cents. Okay. And again, we're going to drag Excel over and we're going to update our our ledger accounts. I'm going to do these in red so you can see. Okay. So you have salaries expense, which is 1,400. And that total is 4,400. And then you have salaries payable, which is 1,400. Go ahead and erase that. You have your supplies that was debited. I mean credited, 870. And then you had your 1,230 or whatever that was left. Okay. And then we need to add a supplies expense. Expense. I'm going to delete all this. Get out of here. Our supplies expense was 870. Okay, and then we're moving on to our insurance expense, which we don't have one of those, so we need to create it. Insurance expense. Okay. And then that was 150 because we used 12 or 1 month of a 12-month policy. And then we go up here to prepaid insurance and we subtract 150. So that would leave us with Jesus Christ at the phone with 650. I think we're gonna make that. We're gonna say that's right. For the love of God, someone answer the phone. Sorry. Whatever. Okay, that's our prepaid insurance. And then we're moving on to our depreciation expense. We also have to create that one. And that was 1410. Okay, and then we need to go up here to our accumulated depreciation and we add 925 to this, which is like 26,825. Right? Yep. And then our furniture, which was 485. 5, 6, carry the 1, 10, 14, 65. And that's that. And then we have our interest expense, which we need to add. And then our interest expense is 1100. Then we go over here to our interest payable and we add that 1100. That's 9,900. Okay, make that a little better. Okay, so was that all the math? I think it was. Right? Yeah. Okay. Excuse me. And you know what? After this, I'll even go through and I'll show you like the closing entries because I'm so nice and generous. Anyway. Oh my God. Completely took my keyboard off. Yeah, this is gonna be a really long recording. I'm really sorry. Okay, let's make this wider. So I'm just gonna copy all this and paste it over. Well, I'm gonna copy all of it actually. And we're gonna paste it over. This is the adjusted trial balance. Okay, can you work? Oh my God. Let's widen these bad boys up. Okay, so cash didn't change. Accounts receivable didn't change. Supplies did change. So instead of 1200, we had, or 2100, we have 1200 feet or 30, or yeah, 30. Okay, our land didn't change, our end didn't change. Our accumulated depreciation did, however. So we're going to increase that to 26,825. And there's 100% a way to do this in Excel where they automatically update, but for the sake of it, I'm just showing you. And our accumulated depreciation for the furniture went up to 14,065. Who snapped me? Eric, whatever. We're going over here to our prepaid insurance, and that's going down to 600 or 1,650. Imagine I get through all this and it's wrong. Uh, it's so funny. No changes to our unearned guest revenue or our salaries pay. Well, yeah, we're increasing. I'm just double clicking and doing insert and shift cells down. And we're okay. Salaries payable. Should have left that shit in there. I can't spell. Salaries payable. Anyway, and then that is 1,400. Our note payable didn't change. Our interest payable did change that to 9,900. Our capital didn't change. Our draws didn't change. Our guest revenue didn't change, but we did have to add some expenses. So, insert, insert. Okay, bro. Merge, merge across. There we go. Okay, and we're going through our expenses. So our salaries expense went up to 4,400. Catering expense didn't change. Utilities expense didn't change. We had supplies expense, insurance expense. Okay, our supplies expense was 870. Our insurance expense was 150. My God. Our depreciation expense was 14,010. And then our interest expense was 1,100. And we don't balance. Why are we $10 off? Am I tweaking? I should write it down or something. Hold on. We're gonna compare. Get out of my way. What did I do wrong? 21, 1,500, 4,400. Oh, you took, no. 1,100. What did I do wrong? It's something in this column. Oh, 8,235. Or 8,25. Okay. We're gonna close mine. What did I do that? That was, yeah, okay, I typed 3 instead of a 2. Whatever. Anyway, and then you balance down here. And I'm gonna work through the closing entries. So, as you'll remember from class today, we do, okay, hold on. I'm not going to do the T accounts. I really don't care. Hold on. Okay. We're going to come over here. I'm going to, whoa, why are you? Oh, because oh my Lord, please, for the love of God, move up. We're going to do the closing entries in blue. Bro. We're going to do the closing entries in blue. Font color blue. I hope you can see this well enough, you know. Okay, so first we close out our revenues. Let me pull, no, I did the notes on paper. I can't even pull it up, sorry. So we're taking our revenue, our guest revenue out. Okay, so we're taking that out. So what's our guest revenue? 17,000, right? And we're crediting the income summary. I'm just doing IS because I don't want to type all that out. Okay. Also, 930. And we're taking out our expenses. So we're gonna do we're gonna debit our income. No. Yes. No. Yeah, we're gonna debit our insurance or our income summary, our insurance, and we're gonna go through and we're gonna snag all of these cute little expenses. New window. Move this over here so I can, read our expenses off. Okay. So we had, I'm just going to copy and paste these. We have, never mind. I'm not going to. Oh my God. Okay. Salaries expense. Holy crap. Okay. We have salaries expense, catering expense. We have utilities. And then we have insurance expense. And then we have depreciation expense, interest expense. And then we have, well, I think that's it. No, supplies expense. Okay. So we're gonna take all of these totals right here. We're gonna take these, highlight, we're gonna put them in here. Okay. So salaries expense is 4,400. Catering expense was 1,500. Utilities was 2,100. Insurance was 150. Depreciation expense was 1,410. Our interest expense was 1,100. And then our supplies expense was 870. And then you're going to highlight that. And at the bottom, it should, down here, it's really small, you can't really see it. It says 11,530. So we're going to paste that. 11,530. Okay. So that's the total of all the expenses, and that's put in the income summary. Real quick, I will actually just show you what happens in the income. Where's my pen? Oh my God. In the income summary account. Okay, so we got income summary account. So we took all our revenues out. Okay. So it has a credit, or it has, yeah, it has a credit balance of 17,000. And then we took out our expenses, and this is just our income. So 17,000 minus 11,530 is like 5,470, right? 5,470. Let me do that math real quick, make sure I'm not dumb. Okay. Ow, Callie just scratched the piss out of me. So 17,000. Why is my calculator? Give me regular calculator. Thank you. 17,000. Oh my Lord. 17,000 minus 11,530. Yeah, 5,470. So this is our, guess what? Net income. Whoa. So then we empty that out into the capital account. Owner's cap. Okay. So we're going to come over here. Let me do a little switcheroony back to my keyboard. 930. Actually, let me indent all these real quick. Select all H. Okay. You have your, to decrease this credit balance, you're going to, oh my Lord, Jesus, income summary, and then Shroot capital. Okay. So you taking the 5,470 out of this account, and you're putting it into 5,470, put a zero, and you're putting that into your capital account. And then, well, I'll show you the draws. Okay. So then, let me do it in blue. You're taking this out and putting it up here into your capital. So it's net income. So it's 5,470. And that is 1,986.90. So then you do your draws. Okay. Then you take out them draws. So 930. Why are you red? I don't want you red. Oh my Lord. Home font color. Make that blue. Let me indent this. So we are increasing or we're decreasing our capital. So Shroot capital. We're decreasing our capital because we're taking out our draws, which was 2,000. Okay. And we're putting the 2,000 or we're pulling it out of the draws. Okay. Let me indent that. So we're taking the 2,000 out. So now that's zero. And all of our expense accounts are gone. All of our revenues accounts are gone because they're temporary. So here we're taking the 2,000 out. And it's 1,900. Whoa, 1,966.90. And if you want me to take these numbers, I'll make like, all the statements for you. But I thought I would just go ahead and, try to explain project one and the closing entries, try and make it a little bit easier. Anyway, I'll email or I'll do something. Like I'll send you pictures of this so you can look over it like while I'm talking, or if you want to like make it while I'm yapping. Hold on. How do I get back to regular? How do I stop sharing? I don't know how to work this. Anyway, are we back? How do I? Bro, I don't want to share my thing anymore. Okay, here we go. You know, um, that was project part it. I I wish you luck for the rest of the semester. I can do this again if you want. I know she records all the stuff, but sometimes people need a little more help and it's okay. Nothing wrong with it, okay? So, don't be hard on yourself. We can bounce back, okay? We can bounce back.